Would you rather have me give you $1,000 right now, today, that you can do with whatever you want? You can spend it, you can pay down debts, you can save it or invest it. $1,000 right now. Or I can make you wait 15 months, 1.25 years, and then I'll give you $1,100 to do with what you want. Right? So either $1,000 right now, today, $1,000, right? None of this is taxable.
Okay.
It's all guaranteed.
All right.
There's no strings attached to any of them. Nothing to worry about there. I can give you $1,000 today.
This is a question about the time value of money and what it's worth now versus...
It's not a trick question.
Okay.
And both answers are correct.
So I am going to take the money now. I'm going to take $1,000 now rather than the $1,100 15 months from now.
Got it. Awesome.
I might not receive that exact same overall return, right? That's
right.
That's a 10% return. But I think that I would take it now. I would take $1,000 now, and then I would put it to work rather than having someone else put it to work for me. That is hard. They're very close, but I think I prefer to have the money rather than the promise of the money.
That's fair. Okay, I got one more for you and our listeners. This is another would you rather. Similar to the first one. Would you rather I give you $1,000 right now that you can spend on anything you want, expenses, paying down debts, investing, savings, or make you wait 30 months, 2.5 years, and then I'll give you $1,300, so $300 more? Which one would you choose? You and our listeners.
Yeah, simply because these are so close in terms of percentage and overall return across that amount of time. I'm probably still going to go with the money now, simply because, I mean, you're saying it's guaranteed in this hypothetical, but I'm not guaranteed to still be here at that time. So I'll probably take it now. Now, I haven't run the numbers. I don't know the exact percentages. So at face value, I lean towards have it now. Yeah.
Awesome. No, I love these responses. There's a lot to unpack here. We'll dive in. So to put some numbers on this, and to our listeners, you might have chosen the same as Danny. Maybe you chose differently. We're going to explore it really quick. So in the first example, $1,000 now or 15 months to get $1,100. That is a annualized return. I had to do a little bit of different math there because it's 15 months, right? 1.25 years.
But that's not accounting for the additional 3 months.
Correct. Yeah, the annualized return on that is 7.65%, guaranteed.
You're tricky.
And remember, no tax either, right? So for anybody that would be worried about a taxable equivalent return, you'd have to be a bit higher than that. So 7.65% guaranteed. And in the second example, it's a 10.54% guaranteed return, annualized over 2.5 years. Now, a lot of interesting observations from this thought experiment, this example. Most people select the first option that I've proposed this question to. I've made a couple observations. For starters, notice I didn't tell the return rate, right? 7.65 and 10.54, because when anybody hears those numbers, they know that those are great returns, especially guaranteed, right? But there's this weird interplay between stated percentages and actual dollars gained over time. You have to wait for those dollars. We perceive dollars differently than just a percentage.
That's fair.
You know, if I just said $1,000 right now, or you can wait 15 months and I'll give you a lump sum equal to a 7.65% annualized return, or wait 30 months and give you a lump sum equal to 10.5% guaranteed return. Some people, not all, but some might choose differently. They might go, well, geez, my bank account's not even half that, and that's 10% guaranteed. I mean, I'd have to go full equities, full stocks to even try to get that, and that's not guaranteed, right? There's risk taken on it. So the conversation, how you perceive it shifts by not saying the percentage and just doing the dollars.
I think there might be a kind of a size or amount comparison here, where
100%.
What if you had said the starting gift is $100K, and then the following year, 15 months, that gift is $110,000, right?
Yeah.
Or after that, 30 months from now, you receive $130,000.
Yeah.
So I think
hits differently, doesn't it?
Hits different because
yeah.
the overall return with the low money, the low dollar amount of 1,000 that you mentioned, you get 100 back, and it's like, oh, well, that's not that exciting at this point, right?
Right. Right.
And so it's kind of like that 1,000 in cash might just be more useful to me at this exact moment. But if you were telling me by waiting, an additional 2 years, 2.5 years, I get another $30,000, which can be someone's annual salary, that changes things because you're thinking in a dollar amount rather than a percentage return.
Yep. Spot on. Yeah. And if you go even higher than that, 1 million, right? 1 million versus 1.1 million
absolutely.
or 1.3 million. And there's a weird irony too when you get to those dollar amounts, because these 7.65% and 10.54% returns, in the real world, you would have to take risk on to get those. But when people hit that $1 million plus range in their investable assets, they're much less open to taking on volatile risk, because seeing 6-figure swings in their account is very hard to stomach.
Gut wrenching.
Whereas, seeing a little 3-figure swing on $1,000, that's not going to be much to most people. So it's just funny how the interplay. So it's just a fun little thought experiment.
Okay,
a couple things. I asked this once to somebody, and I was like, wow, that's a 10.54% guaranteed return. When I say that, would you change your mind? And they said, no, I wouldn't. And I said, why not? And they said, because quite frankly, I don't have much savings. Like, I'm afraid that if something were to happen, an emergency, I wouldn't have enough to cover it. And I don't want to tie it up for 30 months, even if you're offering me a guaranteed 10.54%.
That's self-aware. I think that's smart. Yeah.
Yeah. And it also goes back to what we've talked about in prior episodes about having a well-funded emergency fund could be the key to enabling you to actually take these opportunities when you see them.
Absolutely.
Because you might hesitate if you don't feel secure in your finances. So just another example to reaffirm the importance of an emergency fund, for example.
Great. Yeah, that was a fun little question.